Top of the morning, everybody. Captain Ron here. Today is day one of the new format. It is day 76 of the experiment. We will start where we left off. Today I'll be introducing the portfolios, introducing the experiment. But before that, just a reminder to everybody, this is for entertainment and educational purposes only. And with that, one final view of the mountains. Let's get into it. Captain Ron here, or I should probably say Professor Ron. Today we're going to get a little technical. I call it a thesis. This is actually not a thesis. Is it well substantiated? Probably not. The LH portfolio will be a hypothesis, but we will still call it a theory. Yeah, so not technically correct, but we are here to test it. And we're going to test this in the form of a conformance race. The benchmark is the S&P 500. The portfolio that I think can beat the benchmark substantially is the LH portfolio. Low, high. The idea is to buy low, sell high. And let me introduce the racers. We've got the benchmark, which is an 80-20 S&P 500 bond fund. We have the low-high portfolio, which is the one we'll be trading often. And then we've got some interesting background portfolios, which we will be trading a little bit. One of them is a pharma portfolio, pharmaceutical companies with cash, big earnings, and small debt. We have the Maker Portfolio. This is a portfolio where we're acting as market makers. The opportunity portfolio, this is sitting in cash. It's waiting for big market swings. And then the Mayday Portfolio. This is the second heat of the race. We're on day 76. The second heat starts today. The low-high portfolio is behind the benchmark by 3.7%. So we'll start it at 10,000 today. Start the benchmark at 10,470. Start the farm at 10,000. Start the Maker Portfolio at 10,260. It's been making money on mostly just interest. The opportunity portfolio is just sitting in cash, waiting for the market to crash. And then the Mayday portfolio, which is the big companies, and we'll start that also at 10,000. A reminder, everybody, this is all just pretend money. And we're just trying to see if the low-high portfolio can beat the benchmark. All right, so how have we done in the first part? The low-high portfolio screamed way up. The orange line is 100% return. Then it went way down, went way up, way down, and it passed the benchmark. The benchmark went down with the war in Iran. It came back up with the ceasefire. Our pharma portfolio has gone up and down. Tracked the LH portfolio a little bit. The Maker portfolio has just gone up by the interest rate. And our other portfolio is doing opportunities. So what is the LH? These are small companies. The LH theory, hypothesis, I should say. Small companies, zero earnings. They've got no real history. These are not companies you'd find with a regular search. They're doing mostly R&D. They're trying to develop the next big thing, and when they develop, the stock pops. They have sufficient cash for at least a 2-year runway based on historical data, and we're looking for insider activities. We're looking for insiders who are buying this stock. So these are people that know more than the market knows, and they're buying the stock. And then when the stock pops, when they get the good news, we're going to sell it. So the rules of this portfolio is we're going to hold roughly 10, 8 to 12 initially, and we will set this to 20 if we make some money. We are continually looking for opportunities. So as opportunities show up, we will trade out the lesser ones for what looks like a better opportunity. So there will be some trading with some small losses, small gains. And then the other one is when the stock pops up, when it gaps up, for instance, 60% of the holdings, when it pops up 50%. 50%. And then we're going to repeat that 3 times because some companies will just keep going up. And then after 3, we're just going to hold whatever's left. So we can actually sell 60% of the holdings 3 times. And then also we're going to set a stop loss when the stop drops below 30%. We're going to sell it and replace it with a new one. All right. So a gap is typically when the company introduces some new information and the stock will significantly go up or down. And we're looking for gaps up. One of them is CNSP. This one actually gapped up today. This is not one of our holdings. I wish. We're looking at a monthly chart here, a 1-month chart. These are 1-hour trends. And today it is up 261% is how much it jumped today. So this is a clear gap up. See the gap? This is gapped up. This is what we're looking for. Ideally, we buy it back here. We're going to hold it for a little while and sell it. How long are we going to hold these? Typically up to 6 months. These are not day traders, so we're planning on holding these for a while and waiting for that good news. Okay, our benchmark is an 80-20 fund, S&P 500. The bond, I did a video yesterday of how we chose the bond. We're going to use USFR as our bond fund, which is a treasury floating rate bond fund. We will reinvest all dividends. This is mostly buy and hold, except we will rebalance ideally at least once every 2 years. But if the market shifts by more than 10%, we're going to do a rebalance. Each time it shifts by more than 10%, we'll do a rebalance. And we're going to rebalance maximum of once a quarter. So not too often. If the market's going crazy, we'll do it once, sit back and wait, do it again 3 months later. Okay, so what's in the LH portfolio? Here is the initial holdings. And I will do various shows on companies, get into some of these. But that is the initial set of holdings. The pharma portfolio. Here is its initial set of holdings, and this is mostly buy and hold, although in this one we will also, these have the potential to gap up or down. So if they gap up, we will sell them similar to the LH. If they gap down, we'll do it similar, get out of losers, and then we'll reinvest the cash in similar companies. The Maker Portfolio, these are all SPACs. So the idea behind this is we're buying the SPACs before they have acquired a company, and then when they acquire the company, the stock goes crazy, and ideally we take advantage of that craziness. The Opportunity Fund, this is sitting in all cash right now, and this is we're waiting for big changes in the market. And then we've got the Mayday Portfolio. So this is a portfolio of big companies that everyone should recognize: Exxon, Google, Walmart, Broadcom, United Health, Procter & Gamble, Eli Lilly, and Ambev. This is a mostly buy and hold, and then if the market does do big swings, we will rebalance this one. This is a good one. Should perform well. This one should also beat the market. And then that's it. All right. In closing, I want to encourage anybody that has a thesis, investment thesis out there, to share that with me as a question. Let's see if we can build a portfolio around it. We'll take the thesis, put in some investments, run it through the efficient frontier, and let's see where we get. With that, I will bid everybody adieu.